Everyone wants to pick the next hot stock that will go flying, but I only buy when the price really makes sense. And right now, I have 3 great companies on my list, but I'm not going to go even close to them until they hit the price that I need. And today, I'm going to show you exactly which 3 stocks I'm watching, the story behind them, and the exact price I'm willing to pay before the end of this month. Now, with a channel this big, I'm often asked the question, what stocks am I buying right now? And my answer is always the same. It depends on price versus value. A great company at the wrong price will become a terrible investment. That is why I focus on value, not hype. In this video, I'm going to walk you through these 3 stocks I want to buy, but only if they sell at the right price. And one of them, I actually think it's the single best risk-adjusted opportunity on my radar right now. I'm going to show you the story behind all 3 companies, the valuation metrics that I use, and the exact price point that makes them a buy for me. Because remember, when it comes to investing, it's not only about what you buy, but more importantly, it's what you pay for what you're getting. So if you're new to this, or if you're a repeat viewer, the goal here is to level up your investing game by giving you the tools and principles so the next time you look at a company, you'll have an advantage over 99% of the people out there who claim to be investing, but in actuality, they're gambling. Stock number 1, PayPal. Now, guys, all 3 of these stocks I actually own. But the key here is to remember that we're here to teach a process. You're not supposed to buy a company just because somebody on the internet talks about that. Even if Warren Buffett does it, you're here to learn how to analyze these companies so you can go out there and do it on your own. And PayPal is an incredible business. They had a really strong quarter. A year and a half, 2 years ago, people were saying they were dying. I did not agree with them. I thought it was a great brand that had very good trust in their name. Now, analysts have expected them to earn $1.19 per share in the recent quarter. Guys, they came in at $1.34. Here's where it gets more interesting. They didn't just beat earnings. They actually raised their expectations for next year. They now expect earnings to grow 15 to 16%. That's a strong sign they see good things ahead. In fact, in their report, they talked about how their recoveries and their turnaround is taking good steps ahead. Now, they didn't go so far as to say the worst is behind them, but it definitely felt like that. And now, guess what? PayPal owns Venmo, and Venmo continues to grow like crazy. Their branded checkout is booming, and their total payment volume, which is a fancy way of saying how much money is going through PayPal, is picking up more steam. And the big thing is a partnership with OpenAI. Yes, that big OpenAI, the one behind ChatGPT. They plan to integrate purchases on their platform with PayPal right into the chat. Now, for a lot of people out there, the dividend lovers, PayPal also recently initiated a dividend. I personally am not a huge fan of that, but more power to them. If it's a cheap stock, they should focus their money on buying back shares. Now, all this news is very promising, but it doesn't mean we go out and load the boat with the stock. We still need to understand the business. We need to understand how it makes money, how it can lose money, and then more importantly, how to value the business and make sure we're paying a price below that value. But, spoiler alert, based on today's numbers, PayPal is starting to look more attractive than it has in years. I do not think PayPal is dead. In fact, it might just be waking up right now. But here's the reason why people think it's dead. Here is the 10-year chart on PayPal. This is why they think it's dead. Look at this. Run up to 310 and collapse. News follows the stock price. It could not miss up to 310, and now it cannot hit anything as it fell. Guys, it's ridiculous. It's absolutely ridiculous. We're here to look at the numbers to understand why this happened and why this happened. And remember one thing. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. What that means is, in the short run, what's popular is going to go up. What's not popular is going to go down. But in the long run, the fundamentals of the business are going to drive things. So, here are some fundamentals in the company. Here's what I love. Last year's free cash flow was $5.6 billion. The average of the last 5 years is 5.17. But look at their net income. Lower than their cash flow. That's pretty rare, guys. That doesn't happen very often. They have more free cash flow than net income. So people are mispricing this in that regard. 2, price to free cash flow is almost single digits. It's 12. That's pretty freaking cheap. For a company that's growing, this is selling for company prices that the business is not doing so well, stagnant, or maybe even declining. So you got to remember, is this in line with the company's actual future? Or is it people attaching to that stock price? You got profit margin growing from 14% on average over the last 5 years to 15% last year. You've got decent gross profit. You've got revenue growth in the last 3 years of almost 7%, 10% a year for the last 5, 14% a year for the last 10, and increasing returns on capital. What does that mean for those of you who are new here? Because my goal here is not to overwhelm. And it might seem overwhelming, but I assure you that the more videos you watch, I break this down easily. Returns on capital means when you invest money in the business, do you get a high return on that money? Because if you're investing money in the business and you're making 2 or 3%, you're doing terrible. But if you're investing money in the business and you're getting 13%, you're doing a great job. So if you're new to the video, I can assure you by now, you're probably a few minutes in this video and you've already seen and heard things that are not discussed anywhere else on YouTube. That's what we pride ourselves in. So stick around, watch more videos. You will learn a ton more. This might feel overwhelming. You're not alone. It was overwhelming for all of us, and I'm here to simplify it. Now, these key metrics here are very important, and it's a great place to start to look at a company. But I don't want you sitting here going, what does this mean? What does that mean? So I made it very easy, guys. I made an easy cheat sheet, a PDF that you click the link below, you'll download the PDF, it'll be sent to you, and you can pull it out at any time to understand the importance of all of these metrics on this page. I don't want you feeling overwhelmed, so I made the PDF absolutely for free to make life easier for you. So click that link, and that way you can download this immediately and understand it. Now, let's go to our 8 pillars. Remember, this is not a buy the company because there's 8 check mark here, but this is an 8-pillar stock. It's about understanding the story here. You've got revenue growth. You've got net income growth. You've got profit growth. So when people are saying it's dead, I would look at them and say, how do dying companies have revenue, profit, and free cash flow growth? That doesn't make any sense to me. On top of that, they're buying back shares, and they've been cheap lately. That's a very good thing. For those of you who are new, buying back shares is not a good thing if the stock is expensive. When I say expensive, selling for high multiples of earnings or free cash flow, a high PE. You don't want to buy those stocks, but you don't want to buy those shares back. You want to buy it when it's cheap. And then, of course, the metrics of PE and price of free cash flow are a check mark. So these are good things here. Now, what do we look at? Let's go to analyst estimates. Because remember, analysts are following the company, and it's an important thing for them to sit there and stay in touch with these things. Now, guys, you've seen these things so far. This is exactly why I teach on YouTube. It's because I want to be able to be the person out there who teaches the things that matter, is not just following the hype. And after we do analyst estimates, I'm going to show you the price I'm willing to pay for this stock. For analyst estimates, they have $5.35 per share in profit this year, growing to $8.43. How many dying companies do you know are going to do 14, 11, 13, even, and then 25% earnings growth for the next 5 years? Not many, guys. What about revenue? How many dying companies do you see 4.5, 6, 7, 3.5, and 7% revenue growth? Now, guys, these are analysts, so I get that. And I have my criticism of all analysts. But at the end of the day, I look at this going, if they wanted to shit on this company because the stock price is down, they could easily do that. But they're not doing that right now. So our goal now is to take this information and do an initial run through Stock Analyzer. And the reason being is, I don't want you wasting your precious time researching, falling in love with a company when it's nowhere close to its price. The big thing for me that's different than a lot of those channels out there is I sit there and say, listen, save your time. Go to Stock Analyzer tool. Put your low, middle, and high assumptions in all of these categories for the next 10 years. And if the company's all green, then do your research. But let's say, for example, the company is, right now, PayPal is selling for around $70 a share. Let's say the value comes out at $10 a share. Don't waste any more time. Move on. Find a different company. That's the key here. So let's pull up what the last time I did PayPal and see what values we have. So again, I'm doing a 10-year analysis. You can do it all the way up to 20 years. I did 5, 7, and 9% revenue growth. Profit margin, I did 13, 14.5, and 16. But remember, free cash flow is greater, so I'm going to focus on that free cash flow number, 16, 19, and 22. Free cash flow is the lifeblood of the business. When net income and profit margin is higher than free cash flow, you got to ask the question of why. When it's flipped, you're like, okay, that's a good thing. Still want to know why, but I'd rather have free cash flow higher than profit margin. Next, what is the PE and price of free cash flow 10 years from now? Well, guys, this is one of the most common questions I get. I always tell people the market average is 15 or 16 in the long run. So start there and go higher for good companies and lower for bad companies. What makes a good company? High returns on capital. The last 10 years, it's been growing. That's a good thing. Are they growing? The ones that have a higher growth rate, put a higher multiple on them. Lower growth rate, a lower multiple on them. How's their margins? These guys have good margins and they're growing. So this to me is a premium company. That's why I put 16, 19, and 22. Now, for those of you out there in the community, I would understand if you put 18, 21, and 24. I would get that completely. This is part of the art of investing. And finally, what is my desired return? Guys, I always put 9 or 10% in just to say what's the intrinsic value. But you need to have margin of safety because if you only want 9 or 10%, buy a low-cost ETF. Don't buy an individual company. So I hit the analyze button. The stock's currently at $69.50. This is why you got to do more research. Price is between 80 and 100 on the low side, 170 and 230 on the high side, 120 to 160 in the middle. There's a lot of juice left in this squeeze, in my opinion. I can be wrong on a lot of numbers above and still be okay buying it at $69 a share. That's the reason why. Now, guys, this is really important to understand. Most investors are going to lose money because they're trying to pick not just winners, but the next big thing. The best investors do the opposite. They eliminate the losers first. That's what we're doing here when we analyze a stock. This company might be a loser, but if I'm making reasonable assumptions here and all these numbers are green and I'm looking at return potentials of 14.5 to 27%, if I apply this to 20 or 30 companies, I am going to do quite well. Another thing is, you probably saw this title and got excited to watch this. Guys, I have dozens of companies that I watch. This video is basically about talking about 3 of the better opportunities in those companies. But remember, if prices fell 90% tomorrow, all of those companies would be screaming buys. That's the key here that I want you to remember. I'm trying to teach that process of how you think about companies. You don't think about them as a ticker symbol going up or down or falling in love with a story. You think about them as, here's what I think the company's worth. Can I pay a price lower than that? That's it. Now, guys, our second stock is Southwest. If you've been watching your channel for a while, you've probably seen this consistently for the last few months. And the reason being is, I do believe it's one of the better opportunities out there. The hardest part is, it's an airline. Now, Southwest is going through a lot of changes. You're probably thinking, Southwest, the one that used to have no assigned seats and the 2 free bags? Yep, that one. But here's the thing. Behind all that budget airline charm, there's actually a business that some analysts say could grow its earnings by over 30% a year. And to be honest with you, that's pretty easy when your earnings have been absolutely demolished. Their earnings are down 90% over the last 5 years. Now, before we get too excited, let's break this down like we always do with logic and principle-driven investing approach. So here's what the bulls, which are the optimistic analysts, are saying. They believe Southwest is set up for solid growth in terms of earnings. Earnings can grow 30 to 40% annually. Revenue, 5 or 6% a year. That's pretty solid for an airline. And on top of that, the company is buying back its own shares, which means your piece of the pie gets a little bigger each year. So as an example is, if there's 10 shares outstanding, you own 1, you own 10% of the business. If they buy back 2 shares, there are now 8 shares outstanding, you still own 1, but instead of 1 out of 10 shares, you're 1 out of 8 shares. Just by doing nothing, you became a 12.5% owner versus a 10% owner. You're now getting a bigger piece of that pie. Now back to Southwest. They're working on new strategies, like picking your own seats, improving the profitability, which they already did a great job of before COVID, and a better customer experience. I have a good friend of mine whose wife is a flight attendant at Southwest. And I said to her one time, I said, like, how is it there? Like, what are the problems with the seats? She's like, oh my God, I'm so happy we're going to assign seats. I'm like, really? She's like, every flight there was fights. People would literally come in, put bags down for family that were indifferent. I'm like, really? They're like, yeah, it was always a fight. That's the reason we don't fly Southwest. That's purely the reason. I hate having to like, oh, what are we doing here? Are we doing this? It's like, just stop. But now they're going to do potentially a first class, which is very profitable for a lot of people. And they're getting rid of what my wife calls the herding of cattle, that we have to sit there and go, are you ready? Let's go in there and get him. Like, by the way, the other thing I love about Southwest, I wish other airlines did, Now with other airlines like zone 1, so everybody's like crowded around waiting for the zone to be called. Southwest has a 1 through 5, a 6 through 10, and you just stand there underneath I think it's beautiful. I think other airlines need to do that. And guys, they have a new commercial out. I think it's pretty funny. Check this out.
Are you sitting down? Southwest is introducing assigned seating!
Assigned seating! Now we can choose our seats before we get on the plane. I had a dream about this!
Doesn't every airline do assigned seating?
They do now.
So the question is Southwest a buy? That's for you to decide after doing the work, but I'm going to show you my opinion. Southwest could be a great story, but for us value investors, we don't buy the story, we buy the numbers. We want margin of safety. We want price below value. Price is what you pay, value is what you get. So my thesis on Southwest is very simple. It's not nearly as many things as PayPal. Here's my thesis. In the last 5 years, profit margin has been 1.4%. Last year was 1.4%. Before COVID, they were consistently 10 to 15% profit margin. Best run airline, they stick to the same plane. That means they save on maintenance costs, save on training, and they're the best at hedging their fuel. So my question is, why would they all of a sudden be a 1.5% profit margin business? I don't believe they're going to be. I think they're going to get back to 10 or 15%. That is my thesis. That is 100% purely my thesis. That's it. Now, question is, can they do it? So let's see what analyst estimates are on Southwest. Here's this growth rate. Look at this. 94 cents this year in profit, growing to 666 in 29. Guys, if you assign a 20 multiple to this is a $130 stock if the analysts are right in 4 years. That's the idea here. Even at 15 times, guess what you're at? Yep, you're right. $100 a share. That's the big thing here. That's what I want everybody to understand here. This is purely a play on margin. That's all I think about this company. That is it. Now, let's pull up our stock analyzer to see how much that's worth. So here are my assumptions for the next 10 years on Southwest. 3, 5, 7% growth rate in terms of revenue. Profit margin, I did 8, 11, and 14. And I want to remind you, they did 10 to 15%, a lot of times closer to 15 before COVID. So I feel like I'm being a little bit more conservative here. What PE? Well, it is an airline, which is tough. So I put 14, 17, and 20, but I want to remind everybody of something. In the last 5 years, their return on capital was negative. 10 years is 7.3. So it shows me that before COVID, they were in the 14% plus range on returns on capital. They just need to get back to that cash flow and it'll be there. Okay. And then finally, my desired return, again, of 9%. Now, guys, before I hit the analyze button and show you the price, I want to show you something real quick. If you're scared of losing money in the market, I know why. You've probably been guessing. And I used to do the exact same thing. I would buy stocks because someone on TV said that they're going to the moon. But that's not investing. That's rolling the dice. And that's exactly why I built Everything Money. First, it was built for me. I wanted the tools that gave me clarity and helped take the fear out of investing. People saw me using them on YouTube and said, Paul, how do I get that software? And I used to joke and say, you can't, it's a big data feed. But then it dawned on me, no, I can make this for other people. So I did. And a real community of people who agreed to grow together was born. Real people sharing ideas, live chats, live streams, and tools that help you be better than 99% of investors out there. I still use these tools every single day, like Stock Analyzer, Real Estate Calculator, and Retirement Calculator. So stop guessing, start learning, try it for $7 for 7 days, and see how your confidence will replace fear. Click the link on your screen or go to everythingmoney.com. All right, so I hit the analyze button, and here's why I think Southwest has a lot of potential. Look at this. A low price of 62, high price of 180, middle price of 110. My low return based on free cash flow is 20% a year. My high is 40. It doesn't mean that's going to happen. But if I have 30 or 40 companies priced this way, I am going to do quite well. That's the key here for investing. I'm not putting all my eggs in one basket. I'm just trying to buy a lot of eggs with similar attributes. Stock number 3, our final company is a company you may have heard of. It's called Nike. Yep, the swoosh, the shoes, the goats wear it, the kids line up for it. But here's the real question we need to ask as investors. Is Nike stock actually a good buy right now? Now, for years, guys, Nike was a beast. Dominant brand, global reach, icon marketing, stock kept going up. But lately, the stock has been absolutely crushed. and has been running more like a tired marathoner than a sprinter. Guys, look at the stock price in the last 10 years. Guys, if you go look at our videos, we have videos where we made them when the stock was at 180, and we sat there and said, we're interested under 100, and people in the comments were like, it'll never be below 100. Spoiler alert. $52 was its low in just earlier this year, just 6 months ago. Now, I'm not sitting there saying that we were right. What I'm saying is, if it's not the price that you want to pay, you just move on. But when it was at 180 and people wanted to own Nike, they gave any justification. It'll never be below 100, so I got to buy it now. We sat there and said, maybe you're right. Maybe it never goes below 100. Well, then I just don't buy it. That's the discipline I want you to have as an investor. Not to look at it as, I need to buy this company. Look at it as, I need to buy companies at the right prices. That's the big key there. Now, with this said, a lot of analysts think that this bounce back is coming. In fact, 24 analysts have a buy rating on the stock with a price target of around $82.54. Now, they're analysts, and I don't really look at their buy ratings and all that stuff. I do look at their projections for the company because they're in tune with the company. They talk to them a lot, but I couldn't care less whether they say buy, sell, or anything like that. Because I'm quite sure when the stock was at 180, those same analysts probably had a buy rating because the stock kept going up. And to now sit there and say the price target's $82 makes me laugh a little bit. Now, there are reasons to be optimistic. First off, Nike has a turnaround strategy, and they're getting back to their core. Performance gear, top athletes, and better relationships with their retailers. That's the heart of their business. It's what made them great in the first place. They've also brought back a former executive to help right the ship. And they're leaning into women's sports in key global cities, both areas with tons of growth potential. Guys, we talk about the WNBA all the time. This is being discussed ad nauseum now in a good way. This is a whole new market for Nike to get involved with. Another positive, inventory levels. Not a lot of people think about this, but inventory can be an issue for companies like Nike. They were bloated for a while, but Nike is finally bringing those down. That should help them clean up their wholesale business and get margins back on track. But we can't ignore the warning signs either. Short term, not great. Nike already said the holiday season might be slow and revenue is expected to be flat for the next year. Flat. That's not what you want to hear when a stock trades at a premium compared to its competitors. That's not what you want to hear with any company you buy. You want to hear about growth. So if you're watching this thinking, should I buy Nike today? Remember the rule. If it doesn't fit your price versus value, be patient. Let the price make sense. Don't chase the hype. Don't chase the logo. Chase the value. So here are some things in the company. $96 billion market cap, $112 billion, according to my calculation, enterprise value. That difference there is debt. Not a lot for a company that's generating $3 billion in the last year in cash flow and almost $5 billion a year for the last 5 years. Okay? But as you can see, their cash flow is down. Is that permanent? Well, look at this. Their profit margin was 10.5% a year for the last 5 years. Last year, it's closer to 6.5%. They're trying to get through their inventory, trying to get things moving. This is very typical. Growth rate, it's kind of stalled a little bit. 3-year growth rate in revenue, negative. 5-year, 4.5%. 10 years, 4%. But look at this. 5-year return on capital, 18.5%. In our community, the average community member actually has it a hold with an intrinsic value of 63. So they're kind of like, listen, it's probably selling for what it's worth. The question is it a premium company or has it lost that luster? I don't know. Let's go check out what these analysts think about the future for Nike. Well, look, they have $217 per share, going to $168, then climbing back up, ending at $460 in 2030. So I don't blame them. If you put 20 times earnings on this thing, that's a $92 stock in 2030. Are they being too conservative? I don't know. Revenue, not going well here. Down 11%, even, up 5, up 5, up 6, up 5.5. Let me ask you this question. Do you think Nike's going to be around for the next 20, 30, 40 years? If the answer to that is yes, do you think they're going to have more revenue and profit 20 or 30 years from now or less than today? My guess is more. So the question becomes, what's the right price to pay? And that's when we put it in our stock analyzer tool to figure that out. The last time I did Nike, I put in 3, 5, and 7% growth rate in revenue for the next 10 years. I did profit margin of 9, 10.5, and 12. Same with free cash flow. And guys, I think there's a chance this could go higher because as they sell more to consumers directly, they're going to save a lot of money and make even more money. PE, definitely a premium business. I put 19, 22, and 25 for the PE and price to free cash flow 10 years from now. And again, my 9% return. So guys, I hit the analyze button. So here are the prices I'm getting. I have a low price of 50, a high price of 110, a middle price of 75. Now guys, keep in mind that all these returns include the free cash flow. So include the dividends. So don't add that back in there. Is it a screaming deal? I don't think so, but I think I'm being conservative on these valuations for the company because of what Nike is. Now guys, earlier this year, I picked 7 stocks to start the year to go head to head with the so-called Magnificent Seven, my own Magnificent Seven. I want you to click the video on the screen to see which 7 stocks I picked and how they stack up. The results may surprise you as much as it surprised me. Thank you for your time.